This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Where were we? I was showing you these little formulae, which I hope you agree so far. Individually, the formulae are trivial, yeah? Tiny things. And it's always that's a bit annoying, because, you know, each one's only been asked 2 or 3 times ever. Sorry, we don't risk it. So each one in its own is easy. It's just the fact that, you know, most of them aren't given. However, what have we looked at? The total risk. Add the two together, but we square the standard deviations. The beta, it's measuring the risk relative to the market as a whole. The next one is the most important one of all, and you've seen this. This one is pure revision. That I hope I made clear before lunch, that provided we assume we're well diversified, the only risk we're concerned about is the level of systematic risk. It's the level of systematic risk determines the return we require. Hello? That the more risky the share is, the higher the return we want. The less risky, the less return we'll accept. All right? And the most important formula of all, and I don't believe there'll ever be an exam without this formula in, is the formula at the top of page 39, which tells you what return we'll need for any level of risk. I've typed it there the way it's typed on the formula sheet, which I always think makes it look messier than it actually is. It's so easy it's not true. And this is bound to be there. This formula, quite frankly, although it's on the formula sheet, I really think when you've done it a few times, it becomes so automatic you don't need the sheet. But the important thing, whether you use the sheet or not, is how it works. Can you look at example 4, please? Example 4. Q plc has systematic risk of 6%. The market, remember the market is the stock exchange as a whole, it's giving 12% with a risk of 4. Well, before I go any further, what's the beta of this share? What is the beta of Q? 1.5, I think she's right. The beta, rarely needed, but even so, it's the systematic risk of the investment divided by the risk of the market. Well, this investment has a systematic risk of 6%. The market risk is 4. We are 1.5 times as risky. Everybody? Now, usually, in fact, in the exam, you're told what beta is straight away. The beta is 1.5. But on more than one occasion, you've had to use that. No problem. But again, it's the beta, it's the level of risk that fixes the return we need. It says, what's the required return from Q? Well, all right, I will write down the formula as it is on the sheet. It's RF plus beta I ERM minus RF. But I say the formula looks worse than it is. It's almost too obvious that the return we require, we say it's always going to be the risk-free rate plus a premium. The risk-free rate in this question is 5%. So that's our starting point. If you can get 5% with 0 risk, the return we'll need, well, it would be 5% plus a premium, depending how risky. Would you agree? How much premium do we need? Well, its beta is 1.5. It's 1.5 times as risky as the market. And we say, therefore, we need beta 1.5 times the premium the market's giving. ERM is the return from the market. 12%. The risk-free rate is 5%. Hello? Are we all clear where they're coming from? And therefore, the return we need is 5% plus 1.5 times 7, which is 10.5. It's 15.5%. All right? Now again, I'm not being rude here. A monkey can stick figures in a formula. But if you look at that for 2 seconds and think about it, it's almost too obvious. You don't really need a formula. The risk-free is 5. The stock exchange is risky, but for the risk in the stock exchange, we need an extra 7. Well, if we're 1.5 times as risky, we need 1.5 times that premium. If we were only half as risky as the market, we'd only need half the premium. You with me? And it's only because I keep using the word, and he has. The difference here, 12 is the return from the market, 5 is the risk-free. The difference is called the market premium. Again, the market's giving 7% above risk-free. In this arithmetic, clearly it doesn't matter what you call it. But just be careful in the exam. Once or twice, instead of telling you the market's giving 12, he said the market premium is 7. And you can imagine when you're reading fast, you don't notice and you do silly things. All right? But regardless, I hope that makes sense. But it is almost the most obvious formula on the sheet. And before we go any further, it should be obvious enough, but because this is by far the most important one, could you all write the answer down to this, please? It'll take you 10 seconds, but I'm determined we do it. Suppose I tell you the market return is 15%. The risk-free rate is 8%. And remember I said earlier, the best approximation to risk-free is government securities. If he says government securities give 8%, well, that's your risk-free. Okay? Suppose I tell you we've got an investment with a beta of 0.7. All right? Normally in the exam he tells you the beta. Could you just write down, please? What return would we want from that investment? Anybody? 12.9. Let's check. The return always, if there was no risk at all, you'd want a risk-free of 8%. The more risk there is, the more premium on top of the 8%. The premium is always beta 0.7 times whatever premium the market's giving. The market's giving 15 against risk-free 8. The market, therefore, is giving 7% above risk-free. If we're 0.7 as risky, we only need 0.7 the premium. All right? Natalia, yes. Reda, yes. Ekaterina, yes. I mean, during the rest of what we do, that keeps being needed in various places. But there'll never, ever be an exam where you don't need that. Never, ever. That if we know how risky the investment is, if we know it's beta, then we know what return we would need. Okay? It's a systematic risk determines the return we need. Obviously, if it's less risky, we'll accept a lower return. If it's more risky, a higher beta, you would need a higher return. Okay? All right, the next thing, though, on this, all these little formulae, is that usually in the exam he does give you the beta. You know, I've shown you one way he can trick you, the one before lunch. But usually he gives you the beta, and there we are. In real life, betas are published, certainly for all major companies or sectors. They publish betas. There are magazines which publish them usually every 3 months. So you can look on the internet, albeit the sites that publish betas tend to charge for looking at them. And so if it was ever relevant in real life, you'd sort of look up, you know, oh, the beta for telephone companies is 0.7, there we go. The way they, be aware though, just in case, the way they go about calculating betas, all right, is very much a work backwards. Do you know what I mean? Look at example 5, and he could do this. T is giving a return of 20%. So the return is 20. The stock exchange is giving a return of 25 with a risk of 8. And the return on government securities, remember, are risk-free. They're giving 8%. And this time, last time I gave you the beta and said what'll be the return. Here, I've given you the return. I'm asking you what the beta would be. You with me? So it's the same formula working backwards. Here, the return is what? 20%? It's going to be equal to risk-free 8% plus beta times the market premium. The market's giving 25%, risk-free is 8. Well, although it requires 10 seconds more thought, I hope you're clear, it is using the same formula backwards. And therefore, what is it? Well, 20 minus 8, our investment's giving 12% more than risk-free. It's equal to beta times the market's giving 17% more. And so it must mean the beta 12 over 17. Am I right here? Is it 0.71 to 2 decimal places? All right? Now again, he has done that on his own in the past. That's just almost playing with figures, you know. But it's the beta fixes the return. Normally we're doing, you know, the beta, we work out the return. But he could do it for a bit of fun. If you know the return, you can work backwards and get the beta. All right? Well, I said in practice they publish betas, and effectively they do it that way. They say, well, we'll assume it all works. And assuming it works, if we've got a share giving 20 and the stock exchange is giving 25, well, it must mean its beta is 0.71. You agree? However, even though we assume capital asset works, I think you'd accept, in the real world, nothing's ever going to work perfectly. Surely in the real world you won't be too surprised if some days an investment was giving a bit more than it should, or some days a bit less. Would you agree with me? And so what they do in practice is, although they effectively work backwards, instead of just looking at one day, they look perhaps over the last 5 years. And they list day by day. The investment was giving 20, the market was giving 12. Next week, the investment was giving 25 and the market was giving something else. You understand me? And so they effectively take an average. They look over a 5-year period. Any one day could be distorted. But effectively, they're working backwards over a 5-year period and effectively doing that sort of exercise. All right? Which leads to the next silly little formula, which here I will do one of the examples, but I think this is going too far. It was asked, but it was a long time ago. I can't believe they do this again. But the way they actually do it, because I said we look back over 5 years and see, the market's gone up and down, the investment's gone up and down, how do they match? It's a little bit like working out correlation. And what they actually do, you've got the formula there, the beta, it's a bit like the correlation between the investment and the market. It's the covariance, which I mentioned before, of the investment with the market, sort of how they match together, divided by the variance of the market. Now, I actually wondered whether to leave this out of the notes. This one, quite frankly, I would be astonished if these days he expected you to use. It was only ever mentioned once. It's not on the formula sheet. I don't really want to waste time on it. It would be wasting your time. So although I've put 2 examples, cross out example 7. Well, have a go if you want as a challenge. But that really is going too far. But just in case, look at number 6. If he ever did, I've said he can't ask you to work out covariances and variances. He would have to give you them. Well, it says, what's the beta of R? The covariance of the returns from R with those from the market is plus 32. Yeah? The beta divided by the variance of the market. Well, it says the market's giving 16% with a variance of 25. Well, arithmetically, 32 over 25 is 1.28. Now, as I said, really, to waste time there would be wasting time. You all see arithmetically. All the other formulae I've mentioned, I would, if I were you, learn just for safety. That one, well, I've said, I think it's going over the top. Okay? The rest of the question is definitely askable, though. So can you finish it off? Having worked out the beta, it now says, what return will we be getting from R? So now we know the beta. What will the return be using the formula earlier? Is that correct? Everybody? So sorry, I keep making you do the same thing, but that is guaranteed to be asked. Guaranteed. Almost certainly you'll be given the beta. I don't believe you do the earlier bit. But whatever, once you've got the beta, well, I think already, whether you remember F9 or not, already you're doing it without looking at the formula sheet. I mean, that becomes so automatic. There's no need to waste time.